Hey Ross World, my money makes money. And today I'm going to briefly go over index fund, mutual fund, and my famous ETF, exchange traded funds. So what is the difference? First of all, let's talk about what a mutual fund is. A mutual fund is basically a basket full of stocks and full of bonds and also other type of assets. Now, this portfolio of stocks, bonds, and assets is usually managed by an investment company on the behalf of an investor, which could be you. Now, the big thing about mutual funds is that you could be making money, but they have a lot of hidden fees. They have a lot of fees. So say, for instance, that investment company is investing money on your behalf and they're charging you 1% or whatever you have. So you have $10,000 and they do 1% of $10,000, that's $100 that you're paying for them to do your mutual fund. Okay. Now, when people usually do mutual funds, it's basically they don't have the time to do day-to-day trading, or they really don't want to get into individual stocks, and they kind of just want somebody to do it for them. Now, a lot of people want to know how they pick in these stocks. Basically, they get an investor or someone who's watching the market, and they go and they try to pick winners to put inside this mutual fund. That's why it's a collection. It's a collabo of stocks put together. There may be a few people in the investment company that's picking particular stocks to put in a mutual fund, so that mutual fund can start to earn money. Now, depending on what type of investment company you have in charge of your mutual fund, they have a process what they call active management, where they actually go in and they'll take out a stock, put in another stock, so your mutual fund portfolio continues to make money. So that's basically what mutual funds are all about. So let's move right into an index fund. Now, you guys probably know about the three stock exchanges, where you have the New York Stock Exchange, you have the NASDAQ, and you have the S&P 500, and that's Standard & Poor 500 index, okay? So an index fund is somewhat complicated in the sense that an index can have mutual funds and it can have ETFs. So an index fund, and I'm gonna take someone who's doing really well like Vanguard, what they do is they don't really pick or choose one particular stock. They go to an index like the S&P 500 index, and Vanguard just will buy all of the stocks, all of those 500 stocks. So Vanguard is an investment company that goes and matches the S&P 500 and basically buys all the stocks to match it. Now, they're just earning the average amount within those index, but over a course of time, consistent earnings give you what? Consistent money. Okay, there's certain index funds out there. You know, you have the Russell 2000, and as I stated before, the S&P 500, which people will go and buy because the S&P 500 stocks are blue chip stocks, okay? And the Russell 2000 is the index of small company shares. And the only reason why they buy these because they just want to replicate the performance and earnings of that market. Now, index funds are made to buy and hold. Now, for one thing, they consistently earn, and they're quite cheaper than mutual funds. Now, you can bypass all the fees by using Robinhood, because if you go on Robinhood and you type in the symbol VOO, which is a Vanguard symbol, or VEU, which is another Vanguard symbol. I believe in Vanguard. I believe Vanguard is a tremendous company doing well. They just hit $4 trillion in assets. So these guys are the big boomers in the game. They know what they're doing. And I always push people into ETFs. Now I am pushing you to index ETFs, and I'm gonna tell you why. Because mutual funds are still a safe bet, okay? And they do have some Vanguard index mutual funds, which are still good. But you have to do a little bit of research and to see the outcome and percentages. I'm not saying don't buy index mutual funds, okay? And it's a mixture, okay? And hopefully I explained it, where the index, they just buy those stocks within a particular index to mirror those earnings, and they're doing quite well. Now, another index that you might have heard is the Schwab S&P 500. They just mirroring the basic S&P 500. Like I said, they go out and they buy all these shares, and you can invest in them. Now, the only difference is once they get these shares, is how they allocate particular fractions to make certain money So you can choose either the Schwab S&P 500 index, okay, or you can use Vanguard. Like me, I'm gonna go with Vanguard. I believe I can make some money there. And once again, these are for you to hold, not to sell. Buy and hold. Then you probably say, okay, index fund. So what index fund do I actually go with? Well, there's two types of index funds, okay? See, on one hand, you have your traditional index mutual fund, which is the Vanguard 500 index. As I said, it's a mutual fund index, okay? Then you have what they call your so-called ETF index fund, something like the SPDR S&P 500 ETF, and also Vanguard has a Vanguard index ETF as well. So you can pick and choose where you want. Maybe you want your traditional mutual fund to be with Vanguard, and maybe you want your ETF to be with the Schwab S&P one. So there's a lot of mixture here, and as you can tell, these index funds are dibbing and dabbing inside of the mutual fund and the ETF. So what am I saying? Yes, index funds can be mutual funds or ETF. Now, we have shotgun and destroyed the horse on ETFs, so I know you guys know what ETFs are by now. So basically, all thing I'm trying to say is that an index fund tries to mimic the earnings of the index exchange. So that's why you will see Vanguard 500 index fund ETF mimicking the S&P 500, and they're doing quite well. And like I said before, that code is VOOO, and you'll see that that's an ETF. Then if you use VEU, you use these other ones. If you look up all the Vanguard stock, you'll get all these three-letter codes, and you will see that you'll see mutual fund in the name, you'll see index in the name, you'll see ETFs in the name. So this is just another way for you to make money consistently through the years. And I'm currently reading Tony Robbins' book, and he is speaking largely about index funds, how it's consistently earning. Now, if you mix ETFs, which is a good thing, and you mix mutual fund, which is a good thing, and you throw it into an index fund, which is a great thing, you will consistently make money. And it also, what people were doing during a recession, they had a lot of money tied up into index fund, and they really didn't lose any, and it bounced back. Now, you're not going to see large gains like you would on individual stocks, because what are we talking about again? We're talking about fractions. But I can tell you this, enough fractions make wholes, okay? So if you got, four parts equal one, and you continue consistently to make money over the years. And if you do your research on Vanguard, you'll know exactly what I'm talking about. Vanguard is just replicating and mimicking the S&P 500, and that's how they became a $4 trillion asset company. Okay, and I think they're operating, or their assets themselves are like 1-point-something trillion dollars. Now, you don't get that much money and manage that much money by making stupid mistakes. They're the leaders in the game, in the index fund game, and I advise you to jump on board, okay? I'm not going to tell you which stock or which index or what mutual fund to buy, because that is your own personal choice. Because the easiest thing to say, hey Ross, you told me to invest in these stocks and they're doing horribly for the past 5 years, okay? No. Do your research, be confident in your choices, and start investing your money. Index mixed with ETFs and mutual funds is a very safe bet, but with anything in the stock market, you can always lose. But I can tell you this, I don't think you'll be losing that much. And the stock market always bounces back. So, as I stated before, don't become emotional and take your money out of something that rich people are not going to let fail. Your Rothschilds, your Rockefellers, your Vanguards, all the, your Warren Buffetts, they have all this money in the market. Believe me, they're not going to let it fail. Hopefully this is helpful. You guys really need to get out there and take all that money that you're blowing on the silly things and put it inside of an investment. That way, when you do die or retire, you'll have something, or you can leave something. This is Ross World. Invest some of your money. I'm out.